A lot of people assume their 401k is a complete investment portfolio, and it's not. Most plans cover the basic, like large cap equities and medium term bonds, but even within public markets, there are entire categories your 401k does not touch. I want to walk through some of the major asset classes your plan skips and why that matters for long term investors. Now, most 401k menus stay focused on large cap stocks, international funds, and short to intermediate term bonds. That's the core, but it leaves out a lot. Take junk bonds. These high yield bonds sit between stocks and traditional bonds. They can offer equity like returns with income and behave differently through market cycles. A basic 401k lineup rarely includes these. Options are another gap. Options can act as catalysts for smaller portfolios with long timelines because they let investors shape risk and return in ways that simple stock funds cannot. They also offer income potential through covered calls or cash secured puts, which become more rewarding when volatility rises. None of that exists inside a standard 401k, so anyone exploring options needs an outside account. Long-term bonds are also missing. They are volatile, but that interest rate sensitivity can boost returns when rates fall. If you want that type of barbell bond exposure, it has to sit outside your employer plan. Once you move beyond public markets, the gaps are even larger. Private equity is slowly finding its way into retirement discussions, but very few plans offer it. And because it is so specialized, it has to fit your goals, timeline, and risk tolerance. Private credit is similar. It can offer attractive yields, but the structure and risk varies widely and can require real due diligence. Venture capital almost never appears in 401ks. It offers high potential returns, but also long lockups and meaningful downside risk. Managed futures are another example. These strategies can trend follow across global markets and diversify traditional portfolios, yet they are rarely included in employer plans. Commodity exposure is also limited. Whether through broad baskets or targeted exposures like energy or metals, commodities can hedge inflation and diversify economic cycles, but they are not part of most 401k menus. And leverage, which some sophisticated investors use in very small amounts to reshape portfolio returns, is banned entirely in retirement plans. All of this matters because your 401k is often your largest account, but it only represents a narrow slice of the investing universe. That simplicity keeps fees low, but if you want a more complete mix of assets, you need to build that outside your employer plan. And once you do that, it helps to work with someone who can make sure those assets match your goals, your cash flow needs, and your risk tolerance. If you want a second opinion on how you can balance your 401k with the broader investing world, reach out and we can walk you through it in a simple and risk-aware way.